There's a game happening right now, and you've been playing it without knowing the rules. Every day, your money quietly loses value. Not because you're spending carelessly, and not because you're bad with money. It's because of how the system is designed. Meanwhile, there's another group of people whose assets keep growing automatically, even when they do nothing at all. This isn't a conspiracy theory. This is how modern currency actually works. And once you understand the rules of this game, you'll never look at the money in your wallet the same way again. Let's break down each layer of this game. First, let's ask a simple question: what is money, really? Most of us think money is something fixed, like gold or land, something with inherent value. But the truth is more complicated than that. Modern paper money has no inherent value. It's just a piece of paper with numbers printed on it. Its value comes from one thing alone: trust. Trust that others will accept it, and trust that the government will keep it stable. But trust, like everything else, can be diluted. And that's exactly what's happening. Imagine a small island with 100 people. Only 100 bills circulate on the island, and each one buys a loaf of bread. One day, the island's leader prints 100 more bills. Now there are 200 bills in total, but there are still only 100 loaves of bread. What happens to the price of a loaf of bread? The price goes up, maybe even doubles. Each old bill now buys less bread. This is inflation, shrunk down into an easy example. But the more important question is, where does that new 100 bills go first? In real life, central banks do something very similar. They don't dig money out of the ground. They create it from nothing, with a few lines of code in an electronic system. The total amount of money in the economy increases, but the actual amount of goods doesn't. There are still only so many houses, food is still produced at the same pace. Services are still limited by the number of available workers. When more money chases the same amount of goods, prices are forced to rise. Every old dollar now buys less. But here's the part almost nobody talks about: inflation doesn't affect everyone equally. Let's go back to the island for a moment. Suppose the new 100 bills aren't distributed evenly to everyone. The island's leader hands all of it to 5 people, his closest allies. These 5 people use the money to buy land on the island first, because they heard the news earliest. By the time the other 95 people receive their share, land prices have already gone up. This is exactly how new money flows in the real world. New money travels a specific path, first through the banking system, then through large financial markets. Only later does it slowly spread into the real economy. Who stands closest to the source of this new money? Large banks, investment funds. People who already own stocks, who already own real estate. They're the first to receive the new money, and they use it to buy even more assets. Asset prices rise almost immediately, before ordinary goods and prices catch up. What about the average worker? You're not close to the new money. You're at the end of the chain. Your wages only rise afterward, usually much slower than the cost of living. Companies need time to grow revenue first, before considering raises for employees. While you wait, prices have already quietly climbed. By the time the new money reaches your pocket, it has already lost part of its value. You receive more money in raw numbers, but it buys less in real terms. This is called the Cantillon effect, named after the economist who first described it. Those closest to the source of new money always benefit the most. Those farthest from it always bear the most cost. The wealthy don't need to know this term. They just need to stand in the right position within the system. Picture an economy made up of 2 groups of people. The first group lives mainly off wages, keeping their savings in a bank account. The second group owns assets, stocks, real estate, business shares. When inflation hits, what happens to the first group? Their cash gets eroded year after year. Savings today aren't worth what they used to be. What about the second group? Their assets tend to rise faster than inflation. Why is that? Because assets represent real ownership: a house, a share of a company, a piece of land. These are things with real value, resistant to the paper money losing its worth. Let's try another example, an even simpler one. Imagine you have a bag of apples today. Apples are something people always need, always have practical value. Your friend has an amount of money equal to the value of that bag of apples. But he chooses to hold on to the cash instead of buying apples. A year later, the price of apples rises for various reasons. Your bag of apples is still a bag of apples, still edible, still just as useful as before. But your friend's money now buys fewer apples than it used to. This is the essence of holding assets versus holding cash. Assets tend to hold their practical value over time, while cash simply doesn't have that quality. Over time, what happens between these two groups? The gap between them doesn't just add up, it multiplies exponentially. Those with assets earn more assets faster, while those living on wages alone keep falling further behind. This isn't because the second group is smarter, and it isn't because they work harder. It's simply because they stand in a different position within the same game. Let's look at a simpler example to make this easier to picture. Two friends graduate the same year, starting with the same salary. The first one uses most of his savings to buy a small apartment. The second chooses to hold on to all of his cash, waiting for a better time to invest. Years pass. The first friend's apartment rises significantly in value. He can even borrow against that asset to buy a second apartment. What about the second friend? The money he kept has lost a significant amount of value. Apartment prices are now much higher than before, the opportunity he once had is gone. This isn't a rare story. It's a story that repeats everywhere, in countless forms. Besides inflation, there's another tool that works in a very similar way: interest rates. When central banks lower interest rates, borrowing money becomes cheaper. Who borrows the most money at the lowest rates? Not the average worker. Ordinary people usually borrow less, at higher rates. It's large corporations, investors who already have assets to use as collateral. They borrow money at nearly zero cost, then use it to buy even more assets. Real estate, stocks, new businesses, those assets rise in value. Thanks to the same cheap money spreading through the system, a loop that reinforces itself. Picture a small bakery owner. When interest rates are low, he can easily borrow capital to open a new branch. Revenue grows, and his assets grow along with it. Now picture someone else, who just wants to borrow a small amount to buy a car for work. His consumer loan comes with a much higher interest rate. Because the bank sees this as a riskier loan. Same act of borrowing money, but very different terms. Those who already have assets always get better deals, while those with nothing yet pay a higher price. But interest rates can't stay low forever. When inflation rises too high, central banks are forced to raise rates again to rein in prices. What happens then? People with mortgages, people with credit card debt, people who just borrowed to start a small business. They're the ones who bear the heaviest burden, their monthly payments spike. Meanwhile, who still holds the advantage? Those who built up assets earlier, back when rates were still low. They no longer need to borrow. The assets they already bought hold their value. This cycle of rising and falling interest rates repeats again and again, and each time it does, the wealth gap widens further. You might be wondering, why is the system designed this way? The answer isn't as simple as someone doing it on purpose. The modern monetary system was built to solve the problems of an earlier era. Controlling recessions, controlling unemployment, keeping the economy from collapsing suddenly. But every tool has side effects. And the side effect of this tool is that it favors people who already have assets over people who are just starting to build wealth. This isn't some hidden conspiracy. It's a structure that very few people ever notice. Because it doesn't happen in a single day, it happens quietly, over years, over repeated cycles. So what have wealthy people learned that most people haven't? The first thing, cash is not a safe long-term shelter. It's only safe in the short term. Over the long run, it always loses value. The second thing, assets are a tool against losing value. Not because assets always rise forever, but because they represent real worth. The third thing, Debt, used correctly, isn't the enemy. Borrowing to buy an asset creates value, completely different from borrowing to consume. Wealthy people tend to borrow to buy things that generate money. Poor people tend to borrow to buy things that lose value immediately. This is the core difference, not about how much money they have, but about how they understand and use the rules of the game. Let's compare two simple borrowing decisions. The first person borrows money to buy an old car for everyday use. The moment he drives it off the lot, the car's value has already dropped. He still has to make monthly payments on something that's losing value. The second person borrows money to buy a car to run a ride-hailing service. The car generates steady income every month. That income helps him repay the loan and still have money left over. Same act of borrowing to buy a car, but the purpose is completely different. This is exactly the line between bad debt and good debt. There's a common misunderstanding worth clearing up. Many people think saving more is the only path forward. Saving is important, no one denies that. But saving only solves half the problem, the other half is what you do with what you've saved. If you just leave it sitting in a low-yield account, you're letting inflation quietly steal its value. Another misconception: investing is only for the wealthy. In reality, investing is more accessible today than ever before. You don't need a large sum to get started. You just need to understand the right principles and start early. Time, not the initial amount, is the deciding factor. Let's picture this through a natural example. A small seed is planted in the ground today. It doesn't grow instantly. But over time, it sprouts, becomes a tree, and that tree produces even more seeds. A small amount of money that's invested works in a very similar way. It doesn't generate returns in the first month. But over the years, profit begins generating more profit. This is called compound interest, much like a tree multiplying itself. Whoever plants a seed earliest, even just one seed, often ends up with a bigger garden than someone who plants many seeds later. This is why starting early always gives you an advantage. Even if you start with a smaller amount, compared to someone who starts later with more money. Waiting for the perfect moment to begin is usually far more costly than starting now, even small. This is one of the simplest principles out there, yet one of the least applied. Many people fear the risk of investing. That's completely understandable. But there's another risk almost nobody talks about: the risk of doing nothing at all. Holding on to cash is also a decision, and that decision has its own cost. That cost is your money's value slowly shrinking every year, while the price of the assets you'll want to buy later keeps rising. The gap between waiting and acting keeps growing. Doing nothing doesn't mean you're safe, it just means the risk becomes invisible. Picture yourself sitting in a small boat. The current is flowing slowly, quietly carrying the boat along. If you don't row, you might think you're standing still. But you're actually drifting with the current, you just can't feel the movement. Holding onto cash is a lot like sitting still in that boat. You feel safe because nothing seems to be changing. But your value is still drifting away, carried by the tide of inflation. Here's another way to picture this. Imagine standing on an escalator that's moving downward. If you stand still, you'll still be carried down to the bottom along with it. To stay in the same place, you have to keep walking, against the direction of the escalator. An inflationary economy works exactly like that escalator. If you do nothing, the value of your assets is automatically pulled down over time. Investing, learning, increasing your income, that's the act of walking up so you don't fall behind. Standing still in a system that's constantly moving isn't safety, it's slowly losing. So, now that you understand this game, what can you actually do? First, don't keep all your money as cash. Keep enough for an emergency fund, a few months of expenses is reasonable. Put the rest toward long-term assets. Second, start learning, even just a little at a time. You don't need to become a financial expert overnight, just understand the basic principles. Third, time matters more than your starting amount. Starting early with a small amount beats waiting to start with a large one. Fourth, understand the difference between good debt and bad debt. Debt used to buy income-generating assets is different from debt used for consumption. Fifth, stop comparing yourself to others too much. Everyone starts from a different place, what matters is that you're moving in the right direction, even slowly. Picture two people climbing the same mountain. The first starts from the base, the second starts from halfway up. If you only look at their current position, it seems like the second person is winning. But what actually matters isn't where they're standing. It's whether they keep moving upward or not. The person who started at the base, if he keeps taking steps, can still reach the summit. The person who started halfway up, if he stops, can also end up falling behind. Starting point matters, but direction and persistence are what decide the outcome in the end. Let's look back at everything we've covered. Modern currency isn't a neutral system. It tends to favor people who already own assets. This isn't some hidden secret, it's simply something nobody teaches you. It's not in school textbooks, and it's not part of everyday conversation. The wealthy aren't necessarily smarter than you. They just happen to learn the rules of this game earlier, whether by accident or by choice. And once you know these rules too, you're no longer just an outside observer. But this story is bigger than personal finance. It explains why inequality keeps growing, on a societal scale, not just for individuals. Every time there's a crisis, every time more money gets printed, the gap between those with assets and those without keeps widening. This is why younger generations today feel like life is harder than it was for previous ones. Even though they're working just as hard, often even harder. The problem isn't laziness. The problem lies in the structure of the system they're living inside. So what's the final message here? It's not to make you angry at the system, and it's not to make you feel powerless. It's to help you see clearly the game that's already being played. Once you can see it, you can start making different choices. You don't have to be perfect from the start, just start moving in the right direction. Every small decision you make today adds up to a big difference later. This currency game has existed for a very long time, and it will keep working this way. The wealthy aren't outsiders to the game. They're simply people who understood the rules before you did. The question isn't whether you agree with these rules. The question is, now that you know them, where will you choose to stand? If this video helped you see money in a different way, then it's done its job. It's not meant to teach you how to get rich quick. It's meant to help you understand the system you're living in more clearly. Understanding is always the first step, before any real change can happen. Leave a comment and share your thoughts on this. Where do you think you're standing in this game right now? And what will you do differently, starting today? Thank you for watching all the way through. See you in the next video.